And now to our first conversation. Well, inflation is a global problem, but some countries are winning the battle to tame inflation. Who are those winning central bankers? Let's take a look at some data now. We look at African economies, their inflation and interest rates. At this time, starting with South Africa, we see inflation rate of 5.1% and interest rate 8.25%. Kenya has a 4.3% inflation rate and 12.75% interest rate. We see the likes of Egypt and Nigeria struggling here with 27.5% inflation rate. For Egypt, Nigeria, the biggest there, 34.19% compared to interest rate of 26.75%. But we see Egypt leading with interest rates at 27.25%. Uganda, 4% for inflation and 10% interest rate. Let's look at the countries leading with rate cuts. Right now, we see the likes of Kenya and Uganda, both their last meetings, cutting by 25 basis points. So we're seeing these two countries lead rate cuts right here in Africa. So definitely we're seeing some economies actually lagging when it comes to taming inflation. But we see these ones, Kenya, Uganda, cutting rates at this time by 25 basis points each. Well, joining us now for more, we have Mr. Sam Chidoka as MD Kairos Capital, joining me via Zoom. Great to have you on the show.
Hi, buddy. Good to be here. Thanks for having me.
And interestingly, you're spending your birthday with us. Happy birthday.
Thank you. Thank you. Thank you. Well, it's a work day. We're still at work.
Exactly. So we'll party later, hopefully. Well, let's get into the matters now. We see Nigeria, has the second largest, the largest inflation there number, going by our last report, 34.19% in these major economies in Africa. But we see Egypt leading when it comes to interest rates, and we're behind Egypt there. So talk to me about how this elevated interest rate is impacting domestic investment, in countries like, Egypt and Nigeria. And, looking specifically at Nigeria, we know the banks are tapping the markets at this time. How is it also impacting capital raises?
Okay, thanks. Thanks again for having me. So we've seen the Central Bank of Nigeria and the monetary policy arms of our government do their best to try and tackle inflation by increasing rates. And we can also see that inflation has been growing at a reducing level over the last 3 months, thereabout. So you've seen inflation sort of like temporary, where yes, inflation is still increasing, but it's increasing at a decreasing level from what we've seen, showing that the increase in rates that we've seen is having some effect, perhaps not as much, but some effect on inflation figures. However, when it comes to doing business within the country, you will find that in terms of raising capital, for people who want to raise capital to do business or for whatever venture or for just real estate, cost of capital has increased significantly because of the high inflation rates. And what happens is that cost increase in cost of capital is then transferred also to end users. And so it becomes like a domino effect that just keeps on going around our economy. In terms of the banks having to raise capital at this point, this ordinarily shouldn't have been the best time for banks to raise money. But remember that banks are raising money due to regulatory decisions, not because they want to, but because the central bank has looked at their capital and decided they should increase their paid up capital and share premium accounts, right? So, because if you look at the fixed income side of the market, you can get 26% return by making an investment in treasury bills. So you ask yourself, you take the risk with the stock market. But the banks have also done well. Many of the banks are raising money right now. Dividend yield chasing 10% over time. And hopefully we'll continue to see the banks do well as a long-term investment arm of people's portfolios going forward.
And we know this is about the 13th time we've seen the rate hikes in Nigeria, but inflation, still stubbornly high, but you did mention, it was rising at a slower pace, which, some have seen, as a win. But if we look at what's happening in the U.S., we're seeing investors calling for, rate cuts. We got the jobs report last week, and, it showed that there were signs that the rate hikes were already impacting, the jobs market. So we see the U.S. Fed afraid of, breaking something in the U.S. economy. So looking at Nigeria here, do you think with the rate hikes we've seen so far, we've broken something, in the Nigerian economy?
Well, so in terms of, we've had persistent rate hikes. Yes, you're correct. I think it's how many months now? We've constantly increased NPR, and now we are at 26.75 in terms of NPR. Well, so you have to dimension what we need to do as a nation. There is monetary policy and there's the fiscal policy. What has happened over time is that we've tried to run the economy on monetary policy. And if you take a bicycle as an example, you can't ride a bicycle on one wheel. It's called a bicycle because it has two wheels. The economy is run on the wheel of monetary policy and fiscal policy. The monetary policy side, well, what can they do? Increase rates and try and intervene in the foreign exchange market, all of that to try and tame inflation. But there is still a lot of structural issues in the country that the monetary policy cannot handle. So you have a case of insecurity, which is affecting food inflation. Food inflation is now at 40% thereabout. If you check in 2023 about this time, food inflation was about 25%. So today it's now about 40%. But what is causing it? Because again, we're not able to produce enough food because of insecurity, because of infrastructural issues, because we don't have ways of preserving perishable goods, just ways of moving things from the farm gates to the market gates. So those are structural issues that the monetary policy makers cannot deal with. All right. You also have a case of imported inflation. Some of the things that are imported because our currency has depreciated over time and all of that. So you are seeing that imported inflation also happening. And there isn't so much we can do about that. That's a long-term solution where we become productive and rely less on importing things. But all of these are having effects on our economy. And I think that we've gotten to the place where perhaps inflation is beginning to bottom out. We don't expect to see much increases anymore going forward. There isn't so much room again. I don't know what the monetary policy can do that they haven't done. But I was happy to hear some things coming from the fiscal authority. Just maybe 2 days ago or thereabout, the president's spokesperson announced some cuts in government expenditure. One hopes that the announcement is followed through with actual cuts. They've also announced some cuts across ministries and departments in terms of travel expense, how many people can travel, in terms of ESTA codes, just trying to deal with recurrent expenditure. So the fiscal authority has to come to the party to help with dealing with these issues around inflation.
Right, and I definitely like you to, before I let you go, just pick your brain a bit. Looking at, most other, economies, we've seen the likes of the UK, the US talking about rate cuts. We're already seeing some countries in Africa actually cutting rates at this time. In your mind, when do you see Nigeria's MPC actually cutting rates? Like, how many years from now do you see this happening?
Well, I think that with where we are, the fact that we've looked at the figures, we see that inflation is beginning to increase at a reducing rate. We think that by the next MPC, it will most likely be a hold if things continue the way they're going. And perhaps we begin to see inflation retreat. Maybe sometime about Q1 next year, we will begin to see perhaps some slight cuts in rates, because it's essential. At the end of the day, these things have a cyclical effect on the economy, effects on prices of food items, products that you have in the economy, and those things are affecting. That's what is leading to some of the unrest that we're having. But again, because people do not understand why some decisions have been taken, I think there's some communication that needs to be done in that regard. But I don't see any rate cost cut happening in this year, except you see a massive some level of reduction in inflation, because the MPC has been clear that the increase in rates is to target inflation and to stabilize exchange rates. And with those two, we're still struggling. So we're not like Kenya has 4% inflation, and we're not at the same level at this time.
Yeah, definitely not at the same level. But thank you so much. Always great having your perspective, Mr. Sam Chidoka, MD, Kairos Capital. Enjoy your day.
Thank you.